Hello, everybody. Welcome to the show. I'm John Clay, and I'm your host and chief strategy guide here at Benefits with John Clay. It's October the 12th, and we are getting into part 3 of a 3-part series today on, hey, you think you have everything covered? Do you believe you have less risk being fully insured? You might want to rethink your approach. So greetings, everyone, and welcome to the show. Again, I'm John Clay, your host and chief strategy guide, and everything is good here. I hope all is well with you, and I want to give a shout out to those that have been reacting positively to our show, and also to give a quick shout out to our show sponsor. Today's sponsor is none other than Better Source Benefits. www.bettersourcebenefits.com. Check it out, Benefits Options Solutions, and get started with a quick look at meeting John Clay. That's me. So let's talk a little bit about minimizing risk and how you've already seen in part 1 and part 2. We have actually 28 reasons that we say that you think you're better off or have less risk fully insured. And I think we've gone through the first 20 of those or 21 of those and highlighted pretty much that it's not all that it's cracked up to be. So today we're going to get into the final segment of those 28 reasons. And we're going to talk part 3 of the 3-part series, The True Risk of Fully Insured Medical Plan. So let's get right to it, because here we know just a Milliman survey just came out, and they're talking about in 2022, the cost of healthcare for a hypothetical American family of 4 covered by an average employer-sponsored preferred PPO, preferred provider organization plan is $30,260. You are spending, that's just for the insurance, $30,260. And if that is not a bowl of BS, I don't know what is. Because how many people give $30,000 to someone and say, hey, take care of this for me, and I don't expect to ever see a dollar back? There is no return on investment. There's no accounting. There is no strategy with regard to what they're doing with that money. And at the end of the day, the sadness is it's gone, and you've got to write. If you have a medical event, you've got a deductible and a co-insurance and a copay and everything else stacked on top of that $30,000. Ridiculous. So let's get right into the facts about fully insured. We're going to kick off with the reality is that insurance companies restrict the use of cash pricing. So they've always felt like PPOs have, the best value, get best discounts, but they restrict the use of cash pricing, direct contracting, bundled pricing, and reference-based pricing. So all of these things are new tools that we're using that weren't available some 5 or 7 years ago, but have been in wide use across the country for the last multiple years. And when you prepay your insurance under a fully insured contract, it's clean and thank you very much. But optimizing the use of your money is just nothing that you ever see. You never get any of the moving parts that show exactly where your money goes and how it's being used. So best practitioners and best patient outcomes for a fixed bundled price, that's going to be in a custom plan. It's not going to be found in your fully insured solution. Let's go to the next one. Retention formulas based on premiums, not guaranteed. So if I put a program in front of you, a fully insured program, and we say, okay, you had some retention. Your retention charge is X amount of dollars. And that's a formula that's based on your premium. And they're not guaranteed. There's no guarantee on what those plan performances are going to be from a fully insured carrier, because they don't have to. They just make a decision on retention. The retention calculations are actually a formula that's used to meet their business projections for the coming year. Imagine that. The retention charges work 24/7 against your company in the best interest of someone else. That's a lot of hard work that you do 24/7 against your business. Nobody can stand that. And we've talked about that before. Let's talk about the next item here is rate shock losses. These fully insured carriers rate shock losses into premiums with increases forever, with no lasers, no temporary spike or anything of that nature. And what we're going to talk about here on this is that you've got to love the decision-making framework with your money. If you're an employer, you've got no accountability from a fully insured plan. You've got no accountability to your bottom line. Once you've had a large claim that was pooled or a person has left the plan, do they give you a break on that? Very rarely, if at all. No consideration is given to that person or that risk leaving the plan. So that risk is embedded indefinitely into the rate projection, on and on and on, and it cascades up. And when you get a 3%, it's 3%, it's 9%, it's 12%, and over time, your doubling occurs a lot faster rate than it would if you had somebody watching the store, if you will, with a custom plan has accountability and transparency. Boom. So next up, insurance companies have a minimum rate floor on their pools. Now let's let that soak in. Have you ever had a decline to quote? Have you ever had someone come to you and say, well, the company has declined to quote? This one, ABC or EYG has declined to quote your group. What does that mean when a DTQ comes in? It's not always because you have a bad group. Imagine that. It's not because you have a bad group. It's because you're not meeting their minimum premium standards. And they know that they cannot go below their business plan will not allow them to go below a certain level of premium income for your particular case, whether it's an industry or whether it's a demographic issue. If there is not enough meat on the bone for them to meet their profitability guidelines, then you're going to get a decline to quote. Makes sense, doesn't it? Decline to quote. We can't make enough money on their group. There's no meat on the bone, if you will. Well, that's an indication that it's an opportunity for you to consider an alternative level of funding. All right, let's go on to the next one. No administration expenses or exceptions allowed, okay? When you have an off-the-rack retail plan, those are designed to benefit the insurance company. No exceptions, all right? Imagine a plan that you can design yourself. What would that look like? Would it have a deductible? Would it have an out-of-pocket that's manageable? Would it have copays? Would it have free services like imaging or durable medical equipment or maintenance medicines, maintenance drugs, or a solution for high-cost drugs? Yes, it would with a custom plan. Will it have one with an off-the-rack fully insured program? No, says I. Remember that. No, says I. All right, next up, renewal exhibits use subjective formulas. Now let's talk about that. Anybody remember voodoo economics? That was a term used in the 80s, and it's still the case in fully insured models when it comes to formulas presented in a renewal calculation. As a captive insurance company employee for 10 years, I never got the straight story for a formula for calculating a renewal. Zero training, nada, no bueno. I had to pull it out of my socks to explain a lot of the small group, middle group, and certainly the large group renewals never made any sense. They still don't. They still give you a bunch of data that's non-correlated coherent and non-consequential into the actual rating calculation that goes into your renewal. But they still put it out there every year like it's the gold standard of how they come up with your renewal. Fully insured. Take a walk and you're just going to go right down that same path that you've been going down. It's like, beating your head against the wall burns 300 calories an hour. Those beatings will continue until morale improves. So let's go on to the next one. Overcharge for pooling with no disclosure of the pool loss ratio. So fully insured plans have a pooling charge, and you'll see that in larger groups where they have a pooling charge that's assigned as a cost to your plan. And a lot of times that's what we call stop loss in a self-funded market. And stop loss gives you the security of knowing that no one claim will go over a certain amount. $100,000, $150,000 pooling point is the policy that you buy to protect your group against a huge claim. Well, what does that really mean? Because it should be a claim that's evacuated from your group, right? And never hits your bottom line, never hits your retention level, never hits your renewal calculation going forward. But guess what? No one ever learns what the loss ratio is for that pooling fund. So what is the pool, or the ratio of disclosure of the pool in the pooling charges? No transparency. That's a solution. So that's all I'm going to say about that. There's just another line item in that opaque and vague illustration for your renewal. State premium taxes charged on the gross insured premiums. Folks, this is something that's often overlooked. It's very rarely discussed because it's just considered part of doing business as a fully insured client. But here's the deal. Some have 0, some have up to 12% local tax on your insurance premiums. For example, if you had $1 million premium and you're fully insured, you could be paying as much as $100,000 to $120,000 of that premium is straight taxed back to the city. It's that simple. When a city council or city mayor or someone in the city enacts a premium tax for health, that means that the insurance company has to build in a 5, 10, 12% load on your premiums. So when you look at $30,000 for a family on an average PPO, $3,000 of that could be taxes to the local government on top of whatever it is for you to have deductibles and co-insurance and a huge out-of-pocket limit for these off-the-rack, fully insured solutions. Ouch. That is just an insult to most working Americans, in my opinion. It's just an insult, but I'm not going to get into that. I'm going to go on to the next item, which is reserves exceed what the lag studies support. And this is probably the other big hidden gem in these renewal calculations, is that when you have a reserve, we used to have what we called a rate stabilization reserve amount. And essentially that was a reserve pool that a company would keep on your behalf in an account, supposedly, to offset future claims. It was kind of like your own little pooling charge for your own little group. Well, computers automated this in the insurance company's best interest. It used to be done, and other times claims reserves were stated after review by humans with the intent to reflect a timely total and to reduce fraud, waste, and abuse. Now, those same reserves are subject to refund unless creative accounting can spin it into fluff and spend it to keep the medical loss ratio between 15 and 20%, because the Affordable Care Act on a lot of these fully insured programs requires that any reserve that exceeds 15 or 20%, depending on the pool size, under 50 or over 50, has to be refunded back to the client. Well, how many of you have seen refund checks? We've seen some, but they're very small. And what happens then is you get a refund, and then the next month you get a renewal, and it takes all of it back plus some additional money. So we've had nothing but smoke and mirrors from the Affordable Care Act. We've had the illusion that fully insured is less risky than self-funded. But I think we have 28 reasons that we've highlighted in these last series of shows that highlight the reality that you might want to rethink your philosophy and the direction you're taking on your medical plan. So if you have a group here that you're offering a health plan to at your organization, no matter how it's structured, you're spending a lot of money with a lot of different people. And you're sending money to other businesses to provide health care for you and your employees. And our followers know that the general trend is the industry to go self-funded. I'm beating the drum, I guess, but it's just one of those things that is very dear to my heart, because we've seen very successful entrepreneurs take that and make it work for them. To give you an idea from our own clientele how this is working, 5 years ago, Better Source Benefits had only 8% of our clients doing self-funded. Today, 36 to 40% of our clients are self-funded. And our firm's clientele is fairly representative of small and mid-sized markets from 2 to 2,000 employees located in the Mid-South region across multiple industries, whether it's manufacturing, nonprofits, construction. We have all had very fantastic success stories. We have some results posted in our website, so take a look at www.bettersourcebenefits.com and check on the results tab, because we're not bashful about the successes that we've had. And hey, when 82% of employers with over 250 employees do self-funding, what's to prevent a smaller group, especially if you know what you're doing? A smaller group can do self-funded down to 5 lives. It's unbelievable what we've seen in transforming employees' benefits and employers' bottom line with a true self-funded proposal that restores financial security for employees, transparency to the employer, so that entrepreneurship becomes the focal point of what they're doing on their benefits, and delivers value back to their bottom line on monthly frequency, so they can see and track and watch what is taking place with their money, and in their best interest, not the insurance companies. So remember, you're running a healthcare business whether you like it or not. Whether you have 5 employees or 5,000 employees, you've got a healthcare business unit inside your operation. And is it best left to someone else to manage the money that you work very hard for every day, subject to tax, subject to everybody putting their hand in your pocket to get at some of that money, where you can actually see where every dime goes on this particular part of your number 1, 2, or 3 most expensive business item, and deliver value back to you as an owner, to your employees. So the great news is, the takeaway here, folks, my CEO, CFO, and HR friends, you too can deliver world-class benefits to your employees, world-class health care to your employees at half the cost. So that's it. That's it. The true risk of fully insured medical plans. If you believe you have less risk being fully insured, you might want to rethink your approach. So again, check out our website at www.bettersourcebenefits.com and have a look at that results page for insights on clients that we have helped over the years. And of course, if you'd like to book some time with me, click on the Get Started link with John Clay, and I can help you understand your problems and deliver some solutions. So that's it for today. Join us next week, same bat time, same bat channel, 2 p.m. Wednesday afternoon Eastern at Benefits with John Clay. Hope to see you soon.